Hey everyone, we have a market that is pulling back after its nice rally off lows set in February. So this pullback is, so far anyway, it's relatively orderly and not too surprising. We have a Federal Reserve member who was a bit hawkish yesterday in saying that if the economy continues to strengthen, rate hikes could come as early as April, which is the next Fed meeting. And that, of course, was a bit disconcerting to the markets. I think that it's just a lot of Fed speak, although they have to kind of walk that tightrope in terms of giving the markets the idea that they need to remain vigilant in terms of adjusting rates higher, but at the same time acknowledging that the global economy is still in a quagmire. Therefore, along with all these central banks around the world, I do believe that they will continue to hold the line on keeping rates where they are. As we know, the Fed's dot plot has now reduced the number of hikes this year from 4 down to 2, and then should the global economy continue along this path of non-improvement, those number of rate hikes might go from 2 to 0. And if things should get worse, Yellen has left the door open to the possibility of going into pushing rates into a negative territory, which then would be in chorus with what the Bank of Japan has done and the ECB has done. So far, what those two central banks have done have not improved the economic situation in their countries. In addition, the negative rates put pensions and insurance companies in potential jeopardy without achieving the growth effect that they're hoping negative rates will achieve. So, we're in unprecedented territory. Greenspan said so himself, I think about a year ago. And if you actually go back through 8,000 years of history, there are situations like this that rhyme. We are unprecedented, but you have to go back quite some centuries, and you'll see situations where governments were in the situation they're in today, and that ultimately led to the falling of the fiat currency in question and falling of the government. And that's always happened. I know it's easy today to think, well, we have all this technology that we didn't have 200 years ago or even 100 years ago, and that things are, this time, that whole saying, this time it's different. But I don't see any evidence as to why this time should be any different. Humans are still humans. Emotions are still emotions. Stock charts are still in various ways. They are manipulated by QE, but nevertheless, when the manipulation comes away, then you start to see the patterns emerge again. And the patterns are just human nature on display. So until human nature changes, I think that we're going to continue to repeat this cradle to grave life cycle of fiat currencies. And I think the average lifetime of a fiat currency is something like 42 years or 38 years. It's not very long. And that's why we see regimes topple. It seems to be an inevitability that things have to get worse, as Ed Seykota points out in his book Gavopoly, before they get better. And right now, as he says, his book is titled In the 39th Day, Gavopoly in the 39th Day, meaning we're at the tipping point to the end of what we see today in terms of government power and regimes into something that is, I guess, things have to fall apart before they can fall into place. So that's in other words, this book is actually, it's not a pessimistic view of, oh, the end is near. It's more of the end of what we see today is near to make room for the new. And that, again, that is in keeping with 8,000 years of history. Society doesn't just die off. But nevertheless, it's important to keep a clear head with this, and because with I guess you could call them tidal waves or tsunamis. There's various ones that are on the way. Um, and I mean, off the top of my head, there's so many of these things. For instance, the breakup of the EU, the Brexit situation, and so on and so forth. There's going to be some very profitable opportunities on the way, because any of these tidal waves always bring that. That's part and parcel of a tidal wave. And you know, one tidal wave was the dot-com boom in the late 90s, and then another tidal wave was the bubble popping. And you know, Gil was able to do triple-digit returns, I think, in 2001, shorting the market. So you know, you can do really well even when things look like they're falling apart, you know, and they were for the dot-coms anyway. And the market in general, 2000 to 2002, the Nasdaq was off 78% from peak to trough. So that's no reason to get discouraged. I remember in late 2002, based on my studies, I realized that the risk reward in buying a big position in the triple Qs was much to my advantage based on, we're now talking a long, you know, the history of the markets. So I took a big position, knowing that, and the market did fall further. Of course, I'm not going to nail the low. And that was okay. I had no fear in the trade, because I knew that ultimately, you know, I shut my eyes and the markets are gonna bounce. And of course, you know, that was, I think, the markets went down for another month or two, bottomed in October 2002, and then they were off to the races again, especially 2003. So the lesson there was don't let a dire situation, and things were very dire in 2002, especially with the Nasdaq. I remember when it crossed beyond 75%. First it was 50% off peak, and then it was 75% off peak. And that, you know, then the news accounts were, you know, the end is near for the markets. Markets will never be the same, etc. And that proved to be very close to the ultimate low. So you know, we're in those kinds of shaky times going forward, and the lesson is keep your eyes open, keep alert, and profit from the opportunities as they emerge. And with that, I will turn it over to Gil.
So what is the market really doing here? We got a pullback. You see the Nasdaq approach the 200-day, you pull back. You're extended. I think you're in a position to pull back. The question is whether the pullback turns into something worse. The S&P, you know, this is really just the same old market we've been dealing with. If you look at this, okay, what do we have? A big break, and you rally back to the highs. Last year we had a big break, and you rally back to the highs. Another big break earlier in the year, and you rally back to the highs here. So, so far this market is a lot like last year. You know, it just kind of chopping around. They get everybody bearish. They bring it down hard. You can make some money shorting if you're alert to it, as you could in January and into early February. Then they turn it. Nobody believes the rally. You know, as it's about halfway up, nobody believes it. Everybody wants to downplay it and talk it down. But, you know, everything's so oversold and it's so obvious at that point, they turn the market back to the upside. Now you're back up, approaching the highs on all the major indexes. I think the Dow, let's take a look at this, is right up at its highs. The Nasdaq is lagging a little bit, but one thing I do know, and that might be something that's somewhat cautionary, because what you're looking at here is the S&P and the big caps in the Dow leading the market, and that could be more of a defensive, or have more of a defensive flavor to it. And but you know, they're going into big caps. Also, you see the Nasdaq gets above the 200-day, so they're driving that higher. But I would say that more or less correlates to the Nasdaq composite itself, roughly. And you're coming up into area of resistance along these lows from late last year. So, you know, you're in a position to pull back. The question is, how far does the pullback come in? So, anyways, Dr. K, you hear me okay?
You're breaking up a little bit, which is unusual, because normally you're coming in very clear. But I can still understand what you're saying, so hopefully that's the case for everyone else.
Yeah, I don't know what it is. Maybe we've got too many things running here. So I'm having fun trading currencies right now, so I've got my currency platforms all running, so I don't know if that's creating a problem here. But in any case, just deal with it. Anyways, let's see. So where were we? look at the Russell 2000. It's sort of lagging here a little bit, but it's, you know, and it's way down there. So so far, I think you could argue that this is just a bear market rally. I mean, I think the proof in the pudding will be if you start to see some of these breakouts start to break down. In other words, what's been the typical pattern in the past has been the market breaks down hard, everybody gets bearish, and they start turning it back to the upside. And as you approach the former highs or the prior highs, you begin to, you'll start to see some breakouts occur, you know, so everybody over at IBD gets excited, and there's breakouts to buy in quality stocks, blah, 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 and then the breakouts go up a few percent and then they blow up. And the sign that everything has been coming apart is that the breakouts start to fail. So I think from an objective standpoint, one could simply look at a lot of these breakouts, say here's a Vago's broken out. I mean, it was really a breakout here, and it's run up a good, well, I mean, how far has it really gone? Less than 10%, maybe about 10% from the breakout point, which I would consider to be here and not necessarily here. So, you know, pulls in now along the 10-day, trying to hold. So, you know, watch stuff like that. Some other names, I don't know. Did we put this one as a pocket pivot, Dr. K? I don't remember.
Let's see. I know we did it before. Let me just check on the date. I don't think it was recent. No, we did. Actually, that one, well, that was on March 5th. That was,
So it would have been right
out.
on this breakout. But you see, here's a breakout. I guess you could call this a double bottom breakout. Here's a breakout point right here. So it runs up a little bit and comes all the way back in to retest it. So if you're going to try and buy any of these things, then obviously you want to come in on weakness rather than chasing the strength to the upside. Let's look at some others. Silicon Motion. Okay, this thing broke out here. It's run up a fair bit. And cup with handle type breakout. Let's see what it looks like on the weekly chart. You actually can see it's sort of a funkier pattern than that. It's like a big cup with a handle. So it's almost like a pod with handle sort of thing, straight down, straight up over the course of, it looks like about 1, 2, 3, 4, 5, 10, 15 weeks, 14, 15 weeks, and then it rolls over. Then it sort of builds this funky handle, which looks like another cup with handle. It breaks out here, and it's been running up. Yesterday it was pretty strong on big volume. So here's another one, and I'm going to keep an eye on all of these because I think this is probably what will give you your first clue that we're going to roll over. You'll start to see breakouts fail. So what are some other ones that we put on recently? O'Reilly's actually doing okay. But here again, you've just broken out. If you look at this, here's the base. And it's just trying to break out. So now you're in what I would call failure-prone position. So, you know, that's something to keep an eye out for here. So again, so everybody hearing me better now?
You're a little better.
Okay, I wonder why I'm breaking up. Maybe I should shut some of these programs off. Hang on a second. Okay. Let's see if that helps at all. What are some of the other ones we put on? Oh, here's one. EBIX. Okay. Yeah, it was great. You know, it's actually, this is the breakout here. Okay, so you break out on a big fat move to the upside on huge volume, but there's absolutely no follow through, and the stock comes right back in. So we put it on here, which I thought was a smart place to do it because it's coming into the 20-day line and the top of the base. So if you were going to buy it, that's the spot to buy it. Now it runs back up to the highs, but it comes right back in and it's right back to the breakout point. So I mean, this is pretty much classic sort of action for breakouts in this market, and they just don't really work. So, you know, I think it's just a function of the market, and I think something that you have to deal with and understand.
Oh, yeah.
Go ahead.
I wanted to mention if you could pull up MTSI. On the day we put it on, that was the 4th of
Right here.
March.
Yeah, right.
And people noticed it was a high volume reversal to the upside. It's a very powerful pattern. So, I know we've always said you've got to, buy on weakness in this market. And at the time the pocket pivot was put on, the stock was already up a few percent. The thing of it is, of course, everything's contextual. If you take a look at the situation, first of all, the base is a double bottom. Second of all, it cleared the midpoint. But third of all, most importantly, actually, what sold me on on the idea of taking a position on that extended, it's up maybe 3% at the time, 3 to 4% at the time, is a high volume reversal to the upside. And then sure enough, the next day it breaks out to new highs. Now, in this kind of market environment, that's where you take your profits. You don't wait for the day after where it then undercuts, because we know breakouts are prone to failure, but also it's a semiconductor stock, and semiconductors, even in the late 90s, or the 90s in general, they're very difficult to trade because they tend to have frequent pullbacks after making maybe even a one-day move. So it's hard to stay in these things. I remember I never made much money off semiconductors in the late 90s in general. I think maybe there were one or two, but they just trade more erratically. So when you have this kind of profit, especially in this market environment, take it. And, so your profit taking would have been on the 7th of March, which was the Monday.
Right, where? Here you're talking about? Yeah, okay. So just a couple of days, if we put it on the 4th, which was here, yeah, I mean, you get like a 6, 7, 8% move. So yeah, I mean, you just don't get very much.
It was the day before, so it was a Friday, and it was the day of the upside reversal.
Here.
So, yeah, you would have gotten a few percent out of it.
Right.
Before the breakout.
And then maybe you're trying to buy it back at the 10-day. But that's basically the only way you can operate in this market, because nothing remains coherent. I know one of the better names that I've liked and I've owned on the way up, or rather campaigned, shall I say. A lot of times I don't hold stocks overnight, or I don't hold big positions, but I'll trade them on a daily basis and come back in. This one's looking good, but I figured $30 is about as far as you would get from the breakout point at 26, and that's actually closer to 15% from the breakout point. But you could have been buying it down here. You had a pocket pivot down in here, a gap up move here on a pocket pivot volume signature, and then it holds tight and continues higher. This is when it came out with earnings, and you do a little flipping around, but you have a buy opportunity right here, and then boom, this thing takes off. And up to 30 it reverses, and today now it's getting hit. So here you go again, you have a breakout, and it basically comes all the way back to the breakout point. So another example of a breakout that goes nowhere. The breakouts to nowhere. So anyways, you guys let me know if the audio is getting shaky. I'm not really sure why necessarily that it would happen, because it generally doesn't, but you never know. I'm supposedly paying for this high-speed 300 megabytes per second internet service here, and we actually measured it a couple weeks ago, and it came in at 9 megabytes. So we called Time Warner and complained vociferously, threatening false advertising. Anyways, once you bring out the lawyers, though, that gets them going. So they gave me a 50% discount. So a little hint to anybody out there who's getting like 10 megs on a service where they're claiming to give you 300 or even 50. I think it's all BS. I think a lot of it depends on where you are in the system. Anyways, blah blah. Somebody says they can understand me. Well, that's good. So my teenage kids would tell you they can never understand me, but that's another issue. Okay, let's look at. Let me show you what I'm looking at these days. On the short side, Apple I think is possibly a short. What I'm watching for here is a decisive break to the downside. If you look at this pattern, wow, look at those volume lines, like the New York City skyline there. Okay. You got a big head and shoulders. You've rallied right up into the neckline. Now, you're stuck in what I would call no man's land between the 10-week line, 50-day, and the 40-week line, the 200-day, okay? So you're kind of in the middle of nowhere, but you are coming up into the neckline. So in my view, you could get a reversal here at any point. And you're starting to come off a little bit today, but I'm not so sure the volume. Whoops, give me a second here. I'm going to update this intraday real quick. I don't know if the volume's all that heavy this morning, but in any case, the thing is, to me, it looks a little wobbly. They came out with a product event on Monday, and I didn't see anything that was all that exciting. They got the stock rallying, but it basically flipped back to the downside and came back in. That would have been 4 days ago on the chart here. Now you're sitting at the 10-day line, so I want to check. Volume today is, yeah, it's running just a hair minus. I think that's a minus 9.8%. So it's running just a hair lighter today. So you're not really getting anything decisive. Although, you know, if you came in short the name overnight or hit it this morning, they took it up to 106, I think, and changed briefly, and then took it down to 104. I think somewhere down around 104.89. So it's, you know, it comes right into the 10-day line. So I don't know if this thing's gonna break or hold, but what I'm watching for here is some sort of decisive break on volume. Apple's become a dividend stock. That's the only thing that people say about it, and it's only at, you know, 13 times estimates. The only problem is it's not going to grow more than 10% a year for the next 4 years based on the estimates, and next quarter you're getting negative 14% growth. So, you know, if you want to pay 13 times for a negative 14% grower, go for it. Here we have Netflix, which I think is another one to keep an eye on. This is the basic pattern. It's a late stage failed breakout, and you're coming up into the underside of the base, also getting close to the 40-week line, but you're above the 10-week line. So again, another stock that's sitting in no man's land. So when I look at these, to me, these are all on the cusp of possibly breaking down. So I want to keep an open mind about these as I'm watching these trade in real time. And I've been shorting Netflix off and on over the past few days, and it goes down a little bit, and now it's starting to come off a little bit more. I think we're down, 1.6%, down $1.61. So, you know, if you short a few thousand shares of it, you can make some lunch money. But nothing major. Tesla, I think, should be watched because I think it's becoming a short again. If we look at it on the weekly chart, look at this. I mean, this is crazy. Look at this rally. Okay, that's something like 67%. And then on Monday, some analyst came out and put a buy recommendation on it. And to me, that's probably providing cover for one of their clients who wants to unload stock. That's what it seems like to me, because why would you be so stupid as to call this a buy after it's 67% up off its lows? Anyways, the stock fails there and breaks below the 200-day line. Now it's rallying back up in the 200-day line, which is at 228.46. You're trading 225.37 right now. In my view, this could become a nice fat short here on the rally. So I'd be watching that. I know a lot of people have trouble borrowing this. I can't borrow it, but the other way, or I haven't been able to, maybe. But, you know, that I actually did short it here at the 50-day line, and it came in a little bit. And I remember being able to borrow it then, but I wasn't able to borrow it here, which was probably a good thing, and because it continued higher. But now we're back here, coming up into the 200-day line. Maybe it becomes shortable there. I keep an eye on that. So it looks iffy. Amazon is interesting because there was a story last week where they were talking about Apple leaving them as a Amazon Web Services, or, you know, the cloud service that they have. Apple leaving them as a customer and going to Google's cloud platform. So, you know, that's exciting. And the stock broke down, and selling was pretty heavy, and you undercut this low here from a couple of weeks ago, and you turn and rally. So if you're shorting this, and I was shorting this on the way down, you'd be using a 620 chart to tell you when to cover down here, because anytime I get close, I have a short and I'm approaching an area of potential support, or I see it undercutting a prior low in the pattern, I'm always watching my 620 chart for a possible reversal, so I bail out and make sure I nail down a profit. The 620 chart, in terms of how I apply it to stocks, was originally designed to do that sort of thing, keep me from getting whipped out of, or getting whipped, not necessarily whipped, but having the stock whipped back in my face while I'm still short it, and then just ram against me, ram up my nose, and rally. So I wanted to have a mechanism for taking profits, and that's what started the use of the 620 chart. In any case, now you're rallying back up to the highs of this range. If you look at this, you are probably building a head and shoulders formation, and the rally that forms the right shoulder is always with these head and shoulders will be associated with the market rally. So you're coming up into the confluence of the 40-week and the 10-week and the 200-day and the 50-day, and you're bouncing around. Notice the ranges seem to be getting a little wider here. The 10-week is crossed below the 40-week. That's a black cross, which tells you the odds of it breaking down are increasing, but I'd like to see it on the daily chart too. It's just barely happening. But I would be watching this one as it rallies into this prior area of resistance right around 580 as a potential short sale zone if you get a 620 sell signal. So that's something to keep an eye on, okay? Let's see. There's a bunch of them like this, and I remember, I think last week and the week before, I was talking to you guys about how you're seeing a lot of these ugly duckling setups, very V-shaped rallies. Palo Alto Networks is kind of wedging higher. I mean, as you can see, it's slightly drifting higher, but it's wedging here. And I think a break of the 20-day on some volume would pretty much seal a deal as a potential failure here. Again, you have a late-stage base failure, okay, and you're rallying back up into the underside of the base, and you see these everywhere, okay, and we've been looking at these for the last couple of weeks. But what happens is they bump up in there and they take about 2 or 3 weeks before they start to roll over. So I think you're reaching a critical point in a lot of these patterns, and you want to keep an eye on these as potential short sale targets. And generally the first point of reference for failure, if it doesn't ping off of an area of resistance like the 200-day or the 50-day, so in this case you're seeing a lot of them in no man's land between the 50-day and the 200-day. We looked at Apple, we looked at Netflix like that. And so the 20-day becomes my reference point. Then a break through that could signal that this thing is heading lower. But on the other hand, if you really think the market's getting into trouble here and you want to get short ahead of that, you can always figure, 160, if you saw a rally up to 160, you might short it, or you might try shorting it here and use the high of the day at 156.32, which is not that far away, as your nearby upside stop. Now, it doesn't mean you're going to have immediate success, but it means that you can short it here as long as you have a plan for exit if it turns and goes higher. So we look at that one. Let's look at some of these others that have had funky moves. Again, here's Splunk, held the 20-day. So you see why, in this case, it held the 20-day, and I'm looking for a breach of the 20-day as confirmation. If they can hold the 20-day a lot of times, and again, here's one stuck in no man's land between the 200-day and the 50-day. And it finds support at the 20-day moving average, so it hasn't broken. So that's kind of my reference point. If you want to, you can work on the 10-day as well. So in other words, and this works with Palo Alto Networks as well, if they break the 10-day and they come up near the line, or you can get a short off near the 10-day, then you can use a 10-day or the high of that same day as your stop. That's one way to handle it. I mean, there's a lot of ways to skin a cat on the short side, but it's really a matter of where do you enter a short and where can you optimally enter the position given the parameters of the chart position itself. So in other words, where the stock is trading within its charts. What are your reference points, and what can you use to keep yourself out of trouble? So market's rolling over again. I don't know. I went cautious on this market a couple of days ago, started getting short a few things, even while I was long a few things a couple of days ago. And well, I've been able to make some money on the short side, nothing huge, but that's going to depend on the market itself breaking down. So let's look at a few more of these, okay? Workday. It's forming a nice flag that you can't really fault this. It looks okay. Volume's been drying up on the pullback, but again, the 20-day line, and of course, this is also in no man's land. Now, if you could have shorted here at the 200-day line, and maybe on this other rally here. I've actually bought it on pullbacks, shorted it on the rallies, and traded this range a little bit after making some money on this move up through the 50-day line. But now I'm watching to see if this thing comes apart with a break of the 20-day line. And that's going to be your first sign. So that's something you want to watch for. More. Let's look at more. Google. The same sort of thing here. Look at this. This is really weird. You have this huge break on, I think that was on earnings, and you just blow apart. And now you've rallied all the way back up into the middle of this little structure here, this little V-shaped structure. And I think you're running out of gas here. So this one could blow from here. And again, the 20-day would probably be your first sign of failure, but also it would come down through the top of this little range here and that's about 740, 745, somewhere in there, between the 20-day and that the top of this range here, roughly. So, you know, I think you're looking at potential for a breakdown. It's something I'd be watching for, and of course, this would all coincide with the general market breaking down. So, and we can continue on some of this. Let's look at Facebook. Facebook, I've traded this on the way up and made some money, and yesterday it got up to 113. I thought it could be sold there because it seems to be slightly wedgy. You can see it, you know, this is what Bill used to call wedging along the lows. So what he meant was that if you look at the lows of each daily trading range, even though the highs don't look like they're moving up that much, you're actually getting a pretty good angle of ascent along the lows here. And the volume is pretty weak. You had a spike in volume last Friday, but that was due to triple witching options expiration. So in that case, I think you have to sort of discount that, and it was kind of a churning day anyways. But this could fail again. So I don't know if it heads to 116 first and it breaks out through the high here and IBD declares it to be a base breakout and here's your buy point and blah, blah, blah. If it did, then it'd probably become a juicy short. But I think if the market comes in, this guy's got to come in. And I'd be watching this here. If I was interested in getting long, I'd only be buying pullbacks into the 10 or the 20 day. It held the 10 day earlier. More or less the low here was 111.68 and the 10 days at 111.37. So 20 day at 109.76. I think that would be a much more opportunistic entry point. So, and I think being opportunistic is really the way you want to be. And when I say that, I mean looking to buy weakness and selling and shorting into strength. If you're into shorting and you're oriented that way, I think the idea of buying a stock on a breakout and sitting with it is kind of dumb in this environment, because what happens is you get a decent move, 10% maybe a little more, a little less, whatever, and then you sit there thinking that you're going to ride a big winner because you just read Bill O'Neill's new book, the orange version of How to Make Money in Stocks, and you see all the model stocks that show all these massive moves. So you know you're going to buy a breakout and you're going to make tons of money, right? And you sit there, and the next thing you know, your profits go to nothing, and the next thing you know, your profit turns into a loss. So it's really not that kind of a market. So and like I said earlier, with some of these breakouts that are starting to appear, it makes me wonder whether we're on the verge of some sort of failure back to the downside. So I don't know. Here's a question for you, Dr. K. Are you ready?
Yeah.
In the first book, you introduced the concept of the pocket pivot. You mentioned the pocket pivot should be above the 50-day moving average. Does your work show the pocket pivot more successful if the 50-day is rising, or does it not matter?
It's contextual. You can't isolate just that one rule. In other words, what's the general market doing relative to the pattern that's unfolding in the respective stock? That's really the key question. And then you have to adapt. That's where your chart eye comes in. And you know, we talk about developing your chart eye in our books. So yeah, in other words, there's no easy one-size-fits-all answer to your question.
No, and I'd also point out that the book was written in 2010, and it's been 6 years since then, and one of the newer phenomenon that we have seen are these roundabout and bottom fishing pocket pivots because of the nature of the market, where you know it breaks down, and when it breaks down, the rally back is usually being led by junk off the bottom stocks. So a lot of times you will see pocket pivots in names as they're rounding out. So for example, let's look at, I'll show you one here. This is one I actually played, Mobileye. In here, it was actually having several pocket pivots here. So it is above the 50-day, but the 50-day is descending. But you also had a big pocket pivot here on a reversal at the 10-day and the 20-day, and that's huge volume, and that led to a sharp move to the upside. So another pocket pivot here off the 20-day, and the 50-day is pushing down. So what we've seen in this market is a shift away from the more standard or classic buy points where something is acting constructively and is up high in its base. A lot of the buy points that work the best seem to be occurring in lower parts of stocks' bases. And you know, this is what makes it a nightmare for your typical Can Slim type of investor who just read Bill's book and wants to buy breakouts and thinks they're going to make a fortune. So I have news for everybody. This is not a market to make a fortune in. If you can make 15, 20, 25%, you're doing really, really well. So, anyways, let's keep going. Baidu. Here's Baidu. Okay, another situation here. Well, it's coming up into the underside of this area here. I don't really, this is actually above the 200-day, so it's in a better position. So, but still, a break of the 20-day would probably be your first sign that something is wrong. But all these big stock NASDAQ names have been rallying. LinkedIn is another one. This one's actually in a bear flag. So, and so what you would be doing here is, I think, rallies into the 20-day becomes shortable, although it looks like it may be starting to come loose, in which case you could use a 10-day line at 113.27 to try and put out a position here. With that, if there was no rally back to the 20-day, but a rally probably up to these highs at around 120 or so would probably be the best spot, because that's the highs of the bear flag. So. And I know I saw the article in IBD about the L pattern, which is really just a bear flag. And they use 10 examples of successful L patterns. So what I want to know is, what if I showed you 10 examples of unsuccessful L patterns? What would you tell me? Would you tell me that the percentage depth of the flag was 8.725% and it was 8 weeks in duration? I noticed that they had an average duration of, I think, between 3 and 24 weeks on 10 examples. I mean, what's the variance on that, Dr. K? That almost seems ludicrous from a statistical standpoint. Or am I off base here?
Yeah, those kind of gap downs.
10, well, where they talk about, no, in the study, IBD had a study, they took 10 examples of these L patterns, which are really just bear flags, and then gave you the average depth of the base and the average number of weeks, and that they range from 3 to 24 weeks, which I thought was hilarious, because that's a wide.
Well, yeah, you need a much bigger data sample.
Yeah, and so you remember when Bill had that little exercise when we had the portfolio meetings way back when, and you'd have to come in with 5. He broke us up into teams of 2, so you and I were on the same team. And then everyone had to pick 5 names and then show them, and everybody had to decide whether they would buy them or not. And so what we did is we picked names that totally contradicted the methods. So in other words, they had 5, 6, 7, 8 quarters of great earnings, and the base looked great, and the stock failed. So do you remember that?
Yeah. Oh yeah.
And but the point is, I think a lot of stuff gets cherry picked, and I don't think you can do that. Especially in this market, it's just not that simple of a market. Anyways, that's my thought.
Yeah, it's the most unpredictable market that we've been in.
So, okay, let's keep going. So that's another one. Data is another one of these bear flags. I've shorted actually along here a couple times, and it comes down $1 or 2, and then it tries to go back up. I think at the 20-day though is now your most optimal spot, so something to watch for. Let's see. There's so many of these. Look at this. Along with the semiconductors, you have this rallying up, but look at where it's coming up to. You see this base area. This would be a bear flag on the weekly chart. And it's also sort of a big head and shoulder. So you got a left shoulder here, and then you got a big head, and now a series of right shoulders. You break down, and now you're rallying right up into the underside of this, and you have the 40-week line coming down. So maybe you see it rally one time up up to the 40-week line, and that gives you an optimal short sale point. I think these guys they came out with earnings already, yeah, so not an issue. Nxpi, here's another one. Same situation. It's gotten very close to the 200-day line, but notice here on the weekly, it's rallied up into this area of congestion, and you're into the 40-week line here. So that looks vulnerable. So in a lot of these cases where you've seen these stocks that were real dogs throughout last year, off the peak last year during the summertime in June, and they broke down in August, and they chopped around, and then they rallied back up into resistance in December, and then rolled over again at the beginning of this year and bottomed in February. a lot of them have rallied up into areas where you might expect to see some resistance and that where they could fail. So, you know, there's a huge number of these. They're all over the place. Let me see if I can just throw some others up. UA, here's another one. Under Armour has been rallying. It runs into resistance along these highs on the daily. It never quite gets to the 200-day on the daily. And it never quite gets to the 40-week on the weekly. But again, it's a V-shaped kind of move, chopping back and forth. You could call this a big, ugly left shoulder, a big ugly head, and now it's forming these weird right shoulders. But again, this is another one that may be in position as it comes up into the 200-day line where it becomes shortable again. Let's look at Nike, which gapped down yesterday. This one may become shortable again. I don't know. It had a gap down. It's hanging out around the 10-day and the 20-day, and some heavy selling on the weekly this week. Of course, that's part of the gap down. Hard to figure out. It's kind of in the middle of nowhere, but I guess a rally back up in here might be shortable to the highs of the gap down day, which is 63.45. Not too far from here, maybe 3-4%. Market's coming down 70 now, so here's another one. I'm actually short this one now. I've been working it this morning and put it out on the 620 chart. Of course, it's sort of a stretch here because this is another situation where you're rallying straight down, straight back up into the 40-week line, really close to the 200 line, but doesn't quite get there. But it's very V-shaped and into this area of congestion, the underside of the prior base from which it failed. And now you're reversing. So you had a gap down. This is obviously on the Belgian news. Terrorist attacks there hit all the travel stocks. Priceline, Trip, RCL, a number of them all got hit. And I think it will, if there are more attacks, and there was some news today that ISIS has sent 400 more fighters to Europe to carry out terrorist attacks. And I think Europe is probably, and I think we're pretty bad in the United States. Europe's even more naive in the way that they allow their system to work like a sieve, where people just come right through the borders and they can be terrorists easy for them to get in. And that's why you're seeing them attack places like Belgium, where they have these enclaves that have built up. But it's all because they're overly tolerant. You know, immigration is a good thing, but I think immigration is based on the concept of assimilation. And when you don't have assimilation, then what you do is create a society that is more divided than united. And I think that's not a good thing overall. The U.S.'s great strength in terms of immigration is that immigrants come, it doesn't matter who they are, Irish Italians, Irish Americans, all of whom, by the way, were discriminated against, Mexican Americans coming here and then becoming part of the society and being assimilated. If you don't see that with Middle Eastern or Islamic immigrants, I think that's a problem. So I see more of this happening. And I can extend this to my thinking on some of these travel stocks like Carnival Corp. I think RCL is another one, that they may be vulnerable to downside. And you can see RCL has been the weakest one, okay? And you could call this a bear flag. It's drifting to the upside. Which to me is sort of normal action because it's occurring in synchrony with a market rally, and it's running into resistance along the 50-day. So from here, I'd look at a short on this if it got to 75.64 up to the 50-day. And CCL, I'm shorting because it's reaching the highs of yesterday. So it got very close today. What did we hit? We hit a high of 48.95. And if you look at my 620 chart, in other words, the reason for hitting this is you got a cross up here as it hit that area. So to me, that was a potential area of weakness, and I came after it in there. But I've been hitting it along here. You see here and here, and now it's starting to come in. Am I making any real money on it? Not really. But if you start to get a 620, then it may be reversing to the downside. But you can look at any of these. Look at Trip, for example. That broke down. It's trying to find support along here. But see, this is broken the 50-day, and this is what it looks like. Whoa, what happened there? That's cute. This is so ugly. But notice how it comes up into this area, these lows here, and that's an area of overhead resistance. So you want to look at these on your weekly and daily charts because I think they're vulnerable. And you guys can see, say yes if you are getting the concept, but you guys can see that indeed, a lot of these things are getting into position where they could be shortable, and they might hang around resistance for a few weeks, 2, 3, 4 weeks, sometimes longer, and then they'll start to break. If you study the examples in the new book on short selling, then I think you can get a sense of how this plays out. And so we're getting there. So I think you want to be completely aware of what's going on with respect to a lot of these patterns. So Priceline, let's look at that. Again, it's starting to break the 20-day. So this may, you know, look at this. I mean, here's a head and shoulders. Huge break to the downside. It gets beyond the neckline. So that can happen. And it gets back above in here, back above the 40-week line, and then runs into resistance. So everybody's saying that this audio sounds good now. I'm wondering if it is my Forex platforms. So I've seen them do strange things before. When I log on, I've noticed that my quotes will freeze for a few seconds, and then it may be a hog. I don't know. I wasn't making any money on my positions anyway, so I just closed them out and shut it down. I may revisit that later. In any case, look at this. I mean, is this sustainable? I don't think so. So what's your failure point, the 20-day? You could have used, like I said, in some of these, if you want to keep things really tight and you don't mind being fairly active, you can use a break of the 10-day as a signal to short, and then use a 10-day as your very tight guide for a stop, or your guide for a very tight stop, and now it's breaking down. So let's look at some others. Nxpi, another one in the group. You can see this already ran into resistance at the 200-day line. And again, you got a left shoulder. Maybe this is a big head now, although you're not really getting the big volume I like to see, but it could qualify. But it runs into resistance right at the 200-day line. So it's rallied with the market again. This from here is probably too extended to the downside to short, although if you really wanted to short it here, you could use the 20-day line as a stop. But, you know, again, another one of these examples. And they're everywhere. Everywhere. Let's keep going here. CRM, here's another one. I mean, if you guys want me to talk about some long ideas, I can, but I'm not so sure whether that's really what you want to be looking at right here. Some of the names we've talked about recently, if they're pulling back, you know, you might look at stepping in and trying to buy, but I think that's a tricky proposition in this market right now, given the position. And I'd rather let things play out a little more and see how they consolidate rather than trying to step into every pullback. You know, I know people today are tweeting me that they want to come in. You know, we played Smith Wesson pretty well, and my advice to my members on Gilmore Report actually was to sell. If you buy it, sell it at 30. So it gets 30, that's your target. Boom, sell it. I was just using about a 10% move or so from here. And I also use point and figure charts to come up with price targets, and boom, it comes in breaks, and it's right back here. But I forget what my point was, but you can see how if you think you're going to buy it at the 10-day line on the pullback, because it's been acting well and it has been obeying the 10-day line, the pullback here goes right through the line, and so boom. So you're better off if you get a 10% profit, let things kind of play out. Another one I played this week was Square. I bought a position last week at right around the underneath 12 in here because I thought it was drawing up, holding support along the 10-day in here in a cup with handle. And I guess somebody got wind of some news that Facebook and Square are teaming up or partnering up on ads or something like that. And so the stock ran, you know, is breaking out on Monday. There's a huge short position, like 10 million shares on a 32 million share float. And then yesterday morning, there's an article in the New York Times, and of course IBD had an article, and the stock gapped up in the morning, and then boom, blew up, or opened up and ran up in the morning, and then blew up. And there you have another breakout that, you know, if you bought it, I bought it around 12, so I'm looking at this thing when it gets up to here, and I've got a good 12% or so, 11, 12% profit in it, and I'm going to take it. I'm not going to sit there and think I'm going to buy a break it. This is a brand new leader, and oh boy, it's, you know, it's going to go up 500% because I just read how to make money in stocks. Anyways, let's see what other ones we have here. MXL. Here's one on the long side. So, but again, here you go. Breakout. Oh, it looks beautiful. Boom. Fails. So You are seeing some failures on these breakouts, and especially in the semiconductors, which are looking good. I'd watch for this one. I bet this one turns into a short. Let's see. It's broken out here, and it's run up a little bit. You know, not even 5%. It looks like. What would be 5% on 33? About $1.50. So, yeah, not even 5%. So, you know, that's kind of pukey. And I wouldn't be surprised if you see that fail. But that's what it looks like, a very V-shaped deep base, almost pod-like, you know, after a big run. So you go straight down, straight back up. That's not sustainable. And a one-week candle is just not going to sustain a big move to the upside. That's what I think. So I bought some of this the other day, last week in here, and traded it up, you know, for a couple of bucks, and then I sell it. And I do that frequently, you know, and I keep moving higher. I'm only about 0.5% off my highs for the year right now, up about 15%, just real steady and slow. Because you can't really sit with big positions overnight. If I could, I think I could be up 30, 40%, but it's just too risky. This market's too crazy, and I think a lot of you know what I'm talking about. You know, weird stuff happens. Like, you think the market's going to blow apart, and the next day, you know, the S&P futures are gapping up 20 in your face. So you have to run things a lot slower. You just can't be as aggressive unless you want to risk getting hit. And I'd rather take baby steps rather than trying to hit it out of the park, because it's just not the type of environment for that. And I would say on the long side and the short side. I mean, a lot of things look, you know, perfect in hindsight, but the way this market trades on an intraday basis sometimes, where it'll rally hard and then break down and then rally hard, that makes it very tough. And I think a lot of you know what I'm talking about. So can I get an amen? Let's see. Okay, I like this one. First Solar. Here we go. I mean, this thing looks good. You have a pocket pivot here off the 10-day. It looks like it's going to cruise higher, and boom, it comes right back in. Here's a breakout. If you look at this thing on a longer term basis, going back to, I think, 2014, yeah, it's trying to break out of this base, but I'm not so sure that this just doesn't serve as resistance, you know. So you've broken down, and you're not really able to go anywhere here, and but you break down to the 50-day, you just barely undercut this low, I think. What's the low here? 66.58. You hit a low of, no, just missed it by 3 cents. So, you know, you test the low, you test the 50-day, you undercut the 50-day, boom, you go back to the upside. And I think this may turn into a short, so I'd be watching this one. But you can see here you broke the 20-day line, so I might be looking at a rally into the 20-day line at 69.56 as potentially shortable. But, you know, that was looking good, and it's not. And here's another one, big, beautiful. I mean, look at two big volume spikes. Look at that. You know, according to the O'Neill doctrine, volume is power. And when you see big volume buying in a stock, that's telling you that it's heading higher or has a good shot at doing so. And this thing gets all this beautiful upside volume in it, and it goes nowhere. Now you're down to the lows of the base. It's trying to find some support, but it just doesn't look too good to me. So, you know, I've kind of given up on this stock, so maybe it's going to rally. And you look at some of the other solars, SunPower breaking down, and to me that looks like a fractal head and shoulders. You can see the head here. Here's the big head, and then you got left shoulders, a couple here, the head, one right shoulder, two right shoulders, three right shoulders, four right shoulders, and now it's starting to come off, and this looks like it wants to bust. You know, and so nothing's really going anywhere, even the things that look good, and they're coming back in, and some of them are even failing on breakouts. So I would say, you know, everybody wants to get all excited. This thing's all over IBD somewhere in here. I don't know where, but you can get all excited about it, but it's really going nowhere. And if you own, say, this one, you know, and it's run up, like, you might think about taking a profit. You know, unless you think you're going to make tons of money on what is really an old semiconductor name. So anyways, I don't see any real questions from you guys. You're all just sort of speechless, I understand. Clearly my brilliant commentary along with Dr. K's has completely stunned your brains, and you are completely unable to ask any questions. So I understand that. Okay, so where are we? Dow off about 70, Nasdaq down 1391, so we're off. Is volume heavier today, Dr. K, or lighter? It's running lighter, so not. But again, it's ahead of the 3-day weekend. So what do you think? Would you be buying stocks or holding stocks over the weekend if you wanted to be long? Dr. K?
I thought that was a general purpose question.
Yeah, I mean, would you,
No, I mean,
what,
I don't see anything that's screaming a screaming buy.
yeah.
But if there is a screaming, I don't mind holding something over a long weekend. You know, it just all comes down to the quality of the entry point. But right now, I'm not really seeing anything that's totally grabbing me.
No, and as these names I've gone over, you know, they're marginal breakouts. Some of them are starting to fail, which I think is the first sign that we might be having some trouble here soon. And so, you know, I think you're in a danger zone here, and I don't see any reason to make any big moves just yet, but you definitely can see where some things might be setting up on the short side. And I've gone through a whole bunch of examples, so you have all that to sink your teeth into over the long weekend and work out any shorting strategies. But yeah, I think it's a difficult environment to make big progress, particularly on the upside, unless you're buying something off of the lows, unless you're using bottom fishing pocket pivots and ugly duckling setups. You know, if you were smart enough to catch the move in Tesla, and I don't think there were any pocket pivots all the way up at all, but look at this thing practically straight up. And if you were lucky enough to catch that, then you made some money. But you know, there's no breakout here. And once it gets here, now you got to start looking at it as a possible short. But that's a big move, and that's what's been leading this rally. That's where you can make the money, but it's very difficult to find a practical way of buying them, and even using bottom fishing pocket pivots or roundabout pocket pivots, it doesn't really work in a name like Tesla that has this beautiful run. I mean, that's so uniform. You can draw lines along this to make it this tiny little thin trend channel that just goes straight up. Oh well. If you close your eyes and bought it somewhere in here and you still own it, you know, all I have to say is I'd rather be lucky than good in this market, probably more than any other market I've been in. Anyways, that's all I've got. I hope this was helpful, you guys, because it's a tough market out there, but I think you could be running into some trouble, and I've given you some concrete examples of possible short sale targets. Hopefully that's helpful to those of you who like to short. But other than that, we'll just see how things play out. Maybe more decisive action next week. You got anything to add, Dr. K?
I think that you know, so far the market's looks like it's relatively orderly, especially after its big advance. It's had off the February lows, and you know, the situation in Belgium I think could have been a lot worse for the markets, but the fact that they actually were able to hold their ground in the face of that news says also that the markets are quite resilient. So this pullback, I think, is just a natural pullback, and you know, due to some of the Fed's hawkish comments by Bullard yesterday, that always is unsettling the markets, and that would naturally cause a day to, you know, the markets to be down on a particular remark like that one we had yesterday. So far, I think everything's okay, but of course, keep your stops tight, and watch for you know, any break to the downside in leading names to validate that maybe this rally is at an endpoint.
Yeah, I think the market's got issues. I don't really see this as that orderly, Dr. K. If you look at a lot of stocks and some of the breakouts, the recent breakouts, they're not really acting that orderly. So my view is a little bit different than yours. I think you're in a vulnerable spot, and I would be very cautious in terms of trying to come into the long side in an aggressive way. In the meantime, what I'm doing is watching the short side very closely here, because I want to be on top of a possible break if that happens. So there you have it, you guys.
Yeah, I think that's where that's where the market gets challenging, is because you see these names that are vulnerable, and I do see that myself in individual names. But I think there's also an potential overriding factor of the QE phenomenon, of all these central banks doing what they're doing, and that phenomenon. I mean, we saw this happen a number of times since 2009, where the stocks themselves look just egregiously bad in their patterns, or they look like they're breaking down. Which, yeah, there's a number that look that way. That look, you know, we have some short candidates emerging and so forth. But at the same time, the markets defiantly start to move higher in baby step fashion. And that's my question: if we're going to get that. So when I say orderly, I'm speaking in terms of the general markets and in the QE background that can end up pushing them higher. from here. So in other words, it's essential to remain, as we say to everyone always, flexible and fluid in terms of being a bearish or a bullish type of mindset in the environment we're in, because I think both can occur. Bearish can occur in stocks while bullish occurs in the major averages. And that dichotomy certainly makes for a challenging environment.
Yeah, definitely. Anyways, you guys have a nice long weekend, and we'll catch you next week. Take care.
Take care.